This week, we got updated inflation numbers, and we're going to talk about how they affect your bank account. We're also going to talk about what the Count of Monte Cristo said that rich people do with their money. And finally, I'm going to tell you what I would do in this case to help avoid the impact of inflation on my money. This is the Will Whiten Show. So 2 days ago, the core CPI number came out, and that gives the inflation over the course of a year, excluding energy and food prices. And that number was 2.5%. That's for the year ended July. If we look back to June, the year ended June, it was 2.6%. So it's slightly down when looking over the course of a year. It was mostly in line with everyone's expectations. This is not the number that the Fed targets when they talk about inflation. They talk about PCE, which is personal consumption expenditures, but it's still a useful data point to pay attention to. So overall, that probably doesn't sound too bad to you, but how does it really affect all of our bank accounts? So if you have $10,000 in a bank account, let's assume that it's not earning interest, right? We'll add interest in a second, but let's assume you have $10,000 in a bank account. It's just your typical savings account, and you leave it there for a year. At the end of a year, you will expect the $10,000 to still be there. And we all might think, great, I didn't lose any money, I didn't make any money, but I didn't lose any money, I still have the $10,000. But this inflation number is telling you something different, because it's saying that the price of all the things that you typically buy have gone up by 2.5%. So while you still have the $10,000 in your bank account and you haven't lost that $10,000, that $10,000 can get you less stuff, right? You can buy less stuff with it. And so that's what's meant by your money losing value. So the number hasn't changed in the bank account, but that amount of money is now less valuable because the prices of everything else has gone up. So, and that's what inflation is, the price is going up. So the money that you have is now worth less. I hear many of you probably about to say, well, but I get interest from my money in my bank, and that's more than 2.5%. If we want to be technical, we can then say, well, yes, so say you earn 3.5% on interest. That interest you also then have to pay tax on at your ordinary income rate, and maybe you're still ahead of inflation. If you are, great. But I will say this, it is most likely that if I do this, I will just be running in place. Okay, so even if I'm getting some interest from my bank, and then I'm paying the taxes on it, and that's still above the interest rate, I'm most likely just running in place. This is no way to build a fortune. This is no way to get rich. This is no way to get ahead in life financially. And especially with the numbers that I'm talking about, $10,000 in a bank account, that's not going to make anyone rich. Even if it's $50,000 or even if it's $100,000, right? If you have $100,000 in a bank account and inflation is 2.5%, but you made 4.5% and then paid some interest on it, and say when everything's said and done, you made $1,500 on your $100,000, that's still not rich. You're still not retiring on that. That's over the course of a year. That's not even going to match whatever salary that you might have. So again, it's something to be mindful of, that any cash that's sitting there is at best just running in place and staying at the same value despite the numbers going up. And at worst case is dying. It's actually decaying. It's rotting away. And so that's when I'll hear some people say, well, investing is risky because I could lose it all. Now, yes, if you put all of your money into one particular investment and it goes bankrupt, then yes, you could lose all your money. But if you put your money in an S&P 500 ETF, and this is not my financial advice to you, this is just a theoretical example. If you put all your money into an S&P 500 ETF, the likelihood that it's going to go to zero is very low, because what would that mean? That would mean that 500 of the most successful companies in America have all gone bankrupt. Something would seriously have to go wrong for hundreds of American businesses, large American companies, to go bankrupt. And so, yes, I don't think it will go to zero, but you might lose one year and make another year, lose another year and make more another year. It's averaged about 10% over decades and decades. But at the same time, by just leaving money in a savings account, it's actually a guaranteed loss. I view that as a bigger risk. You say, well, I don't want to lose a little with a chance to make some, but then so the best route is just to definitely lose a little bit every year. I don't see that as the best path forward. So the question becomes, okay, I hear you. I'm not just going to leave all my money in cash. I don't want inflation to eat it away, but what can I do with it? What do rich people do? I'm going to use an example from the Count of Monte Cristo. So I'm going to read from that. And this is Monte Cristo talking to a character, Danglars, and he calls his fortune, Monte Cristo calls Danglars' fortune third rate, and he's a bit puzzled and humbled by it. And he says, "What do you mean by that?" "Certainly," continued Monte Cristo, "I make 3 assortments in fortune: first rate, second rate, and third rate fortunes. I call those first rate, which are composed of treasures one possesses under one's hand, such as mines, lands, and funded property, in such states as France, Austria, and England. Provided these treasures and property form a total of about 100 million, I call those second-rate fortunes that are gained by manufacturing enterprises, joint stock companies, viceroyalties, and principalities, not drawing more than 1.5 million francs and forming a capital of about 50 million. Finally, I call those third-rate fortunes, which are composed of fluctuating capital, dependent upon the will of others or upon chances which a bankruptcy involves, or a false telegram shakes, such as banks' speculations of the day." So this is him breaking out 3 different types of fortunes. And I gave the example before of people concerned, oh, well, if I invest, I could lose all my money. Well, right here, he's explaining that's an example of trying to make a third-rate fortune, one that can be won or earned or grown through speculation, right? That would be something highly speculative, to just throw a bunch of money into one company that you have no control over and it goes to zero. That would be speculative. And that's kind of what was happening with the Danglars character. He was engaging in some very speculative things. So that's why Monte Cristo assigned that. But if we look at what a first-rate fortune is, he says mines, lands, and funded property. I think by funded property, he means without debt. I think he means paid for, because later in the chapter, he also talks about debt and how Danglars' fortune isn't really what he thinks it is, because it is largely built on debt. And so I know a lot of people might take issue with that, and they'll say, well, Dave Ramsey harps on that, and he'll reference the Bible and say the borrower is slave to the lender. But if you want another example, the Count of Monte Cristo, I believe it's about 185 years old, and here's an example of someone saying that it should be funded property, and he talks later in the chapter about not having a bunch of debt and having real money, real capital, and it's invested. And that's where a lot of the money is that rich people have. It's invested in things that are growing and paying them. It's invested in production. There was an interview, there was a speech that Milton Friedman gave. It's on YouTube. I believe it's from 1980. And he was taking questions, and there's a woman that starts talking about how all of the wealthy people are hoarding the money. They're just hoarding it all for themselves. And Milton Friedman pushes back and says, well, what do you mean? Explain. What do you mean they're hoarding? What are they exactly doing with it? And she fumbles a bit. She couldn't quite answer the question. She says, well, they'll buy oil and stuff, which is a weird answer, right? I don't think that's how all rich people make their money or store their money. They just buy a bunch of oil in barrels. It didn't make sense. She didn't really know. She's just been told before that that's what rich people do. Once they get money, they hoard it. But if we take the example of Elon Musk, right? I think his net worth was briefly over $1 trillion. I don't know if it is at the moment. And a lot of people will say, well, think about what he could do with that $1 trillion if he gave it away. And the truth is, he doesn't have the $1 trillion to just give away. It's invested in stuff because he's one of these rich people. He has one of these first-rate fortunes. He owns things. I'd be surprised if he even had $100 billion in cash. It's probably less than that because it's largely tied up in the companies he runs. And if he were to try and sell all his stock in all the companies that he owns, a lot of those companies' values would probably drop dramatically. He probably wouldn't be able to sell it fast enough to enough people before the price started falling off a cliff. And he would certainly not be able to clear $1 trillion into a bank account then if the price started plummeting because Elon was divesting of all these companies that he's created. So the wealthy people don't have all of this cash just sitting there. Why? In part because they understand that inflation will just chew it up. It will eat away at it. And they need their money to grow. And that's where we come to the practical step and something that I think is important that I do. Again, this is not financial advice, but I think it's always important to consistently invest and invest aggressively. And when I say aggressively, I don't mean speculatively. Right? I don't mean trying to find that home run return. I mean aggressively in putting as much money as I can into investments, not just sitting on a ton of cash. I know some of you might be saying, well, wait a minute, Berkshire Hathaway and Warren Buffett and Greg Abel, they're sitting on $400 billion worth of cash. A lot of that is in treasuries, so they are getting some slight return. But some of that cash is dying or at best just running in place. And that money does need to be put to work in order to grow properly. They know that, but they're very picky with their investments. And they also know that there's going to be a time when the market completely tanks again, and then they can run in and get some really great deals on companies. So as far as the inflation number, it seems to be roughly unchanged from last month. But what does that mean for us? It means that a lot of money that we have is always going to be taking it on the shins from inflation. Can't just pile it up and hoard it. That hoarding mentality doesn't work. It doesn't allow money to grow. The money must be invested in productive assets like the Count of Monte Cristo talks about, whether it's mines or business enterprises. And that's something that I try and do. I try and make sure that my money is invested so that it can grow, so I can become wealthier, and that the money doesn't just sit and rot away. Have a good night.